Hi guys, good day. This is Rony Velasquez with Berkshire Hathaway Home Services California Properties, and this is part 2 of a two-part program aimed to working with buyers. Okay, so this is part 2. We do these classes on Saturday, and in the morning we do the prospecting for buyers, buyer pre-qualification, asking the right questions, marketing open houses and things like that. In the afternoon, I talk to you about mortgage financing. Now, because of the limited time that we have in this video, because this is a 30-minute video of a 3.5-hour class, okay? So based on the limited time that I have right now, I'm not going to be able to cover everything, but I'm going to try to get to you the most important information regarding the program. The very first thing that I want to mention is that as part of the program or coming to the class, there is this spreadsheet here. It's called the Mortgage Calculator 27.0. This spreadsheet is completely free and it's available to you. This is something I created in order to help you be able to pre-qualify buyers during open houses based on the basis of income. You don't need a lender to do this for you. I'll explain you the whole process, even though obviously I recommend that you work with a lender. I just want you to be self-reliant and be able to answer questions, simple questions that people have, for example, in regards to how much my payment is going to be, how much is going to be for interest and principal, how much is going to be for property taxes and insurance, and the next part, which is what is the amount of income that I need in order to qualify, and if I don't qualify for this property, what is the most that I can buy with the income that I have? All of those questions can be answered using the mortgage calculator. Now, here's an advice for you. If you go to my YouTube channel, my training channel, I have a training channel in YouTube called Maya Team TV. That's MAYATEAM TV, as in television, Maya Team TV. So just go to YouTube and put Maya Team TV, subscribe to my channel, and you're going to be able to watch this video. So I'm not going to cover this right now because I explained this process in about 14-15 minutes in that video. So let's move on to the next part. Today we're going to talk about the most popular loan programs. I am going to clarify some misconceptions that people have in regards to mortgage financing, especially some of the loan programs out there. So let's start with the first one. The most popular program, FHA. That's the most popular program. Now, one of the misconceptions that people have in regards to FHA is that FHA is for first-time home buyers. FHA is not for first-time home buyers. Maybe used to be many years ago for first-time home buyers, but right now it's not for first-time home buyers. The basic rule for FHA, they only have 2 rules. Well, they have more rules, but they have 2 basic rules, which is number 1, the property has to be owner-occupied 100% of the time. It has to be owner-occupied. See, the government doesn't help you buy a property so you can become a landlord. That's not their goal. Their goal is to increase home ownership by means of helping people come in with lesser down payment, lower FICO scores and so on. So one of the most basic rule about FHA financing is that it has to be owner occupied. The second rule is that you can only have one FHA mortgage at a time. So see, most people say, well, FHA is not for first time home buyers. It's only for first time home buyers. Well, not in reality, it doesn't work that way, because if you own a property right now on a conventional loan and you want to buy another property FHA, you can do that, provided there's certain rules that you need to abide by, but you can do that. You can buy a property as an FHA mortgage, 3.5% down payment, even if you own 1 or 2 or 3 other properties, as long as you cover some of the rules. So that's the first thing. The first thing is that most people get confused because they say, oh, FHA is only for first-time home buyers. It doesn't. It's not. It's not. Even if you own a property and you sold the property, or you foreclose on the property, or you short sell a property, you can still buy under FHA financing. So that's the first thing. The second thing regarding FHA is that the minimum down payment for FHA is 3.5%. 3.5% of the sales price of the property, which is very convenient. Very convenient, because some other loan programs, they require a higher down payment. So FHA 3.5% is really, really good. Across the board, through all the loan programs right now, except the down payment assistance program, the minimum FICO score is 620. So FHA's minimum FICO score is 620. So those are some of the advantages of FHA. Another advantage of FHA is that the ratios, the expense ratios on housing plus consumer debt are a lot more tolerant than conventional loans, being at 45-55. Now, in the video, I explained to you exactly what ratios is, but to make it really, really short, think of a ratio like a portion of your income. So a ratio is a portion of your income, right? The government says we want to make sure that your house payment does not exceed 45% of your gross income. 45% of your gross income if you are an employee, or 45% of your net income if you are self-employed, right? So the first ratio you have to remember is 45%. The second ratio that you have to remember is 55%. What does that mean, 55%? That is to say that your mortgage payment plus your consumer debt. What is consumer debt? Credit cards, auto payments, student loans, and any other debt that shows up in your credit report. That's what consumer debt is called. So your mortgage payment plus your consumer debt cannot exceed 55%. As long as you keep it under 45, 55, you're okay. Now remember, 45, 55 is the limit, so you want to keep it under that, maybe 42, 50 or something like that. You don't want to go to the limit every single time. But consider the following. Conventional financing ratios is only 39.43. Conventional financing and down payment assistance programs is 39.43. Now, it may not sound like a lot to you, all right? You're like, okay, 45, 55, 39.43. That doesn't sound like anything, but consider this. If you have a borrower that qualifies on an FHA program for, let's say, $400,000, for example, if you turn that FHA program into a down payment assistance program or a conventional loan program, they would only qualify for around $350,000. You just lost $50,000 of purchase power by changing from one program to the other. So you have to be careful with these things. These things are the things that actually kill your transactions if you're not careful with them. Another thing in regards to FHA, the loan limits is really high. The loan limits, at least for Los Angeles County and Orange County, is really high. I think right now $655,000, I believe it's somewhere around there. But if you go to 2 units, it increases over 700, and then if you go to 3 units, it's like 800,000, and then if you go to 4 units, like $1.2 million. So I mean, they can cover a huge range of properties, especially in Los Angeles County and Orange County. Now, Riverside County and San Bernardino County, the limits are a lot lower. So I think it's like 355, I believe it is currently. Don't quote me on that, but you can go to Google and just put HUD loan limits, HUD, Housing and Urban Development loan limits, and you'll find them right straight out. So here's another benefit of FHA program, for example, is that the loan limits are a lot higher than most of the other programs. So that's another benefit. Another one is that gifted money is allowed up to 6%. So the money can be gifted. Who can gift the money on an FHA program? Their family can gift them. Yeah, their parents, brothers, sisters, cousins, whatever. Sure, they can gift the money. Who else can give the money? Your employer. As long as the employer signs a letter stating that the money is not going to be repaid. That means that the money is factual and true, it's a gift and it's not a loan. So you can do that, right? So gifted money is allowed up to 6%, which 6% will cover probably all of the down payment and closing costs if you're going to do that. So you can do that. Who else can give you the down payment money and gifted funds? Down payment assistance programs. FHA allows down payment assistance programs to give you money to buy the property. We're going to go into down payment assistance programs in a second. Let's just keep it like that for now. Now, some of the disadvantages of FHA. And like I said, FHA is a great program. Higher ratios, lower FICO scores. They're more lenient with debt and collections and things like that. So overall, it's a great program. But it does have some disadvantages. One of the disadvantages of FHA is that it has to be owner-occupied 100% of the time. You cannot purchase a property and say you're going to live there and not live there. That is not right. So they may decline the loan because of that. So you have to be careful with that. Number two, the debts of one spouse need to be considered for financing, even though that spouse may not be on the loan. So let me explain you the reason why. California is a community state. So California as a community state, the debts of my spouse are my debt. I'm responsible for the debts of my spouse and vice versa. She's responsible for my debts, you see, because we're in a communal state, a community state. So what happens is that if you're going to approve for a loan and you're not going to use your spouse, you still have to run the credit and you still have to consider the debt. So if your spouse has a lot of debt, this is going to be a problem for you. So the only other choice you have is going conventional, because in a conventional loan, you don't necessarily need to run the credit on the spouse, so you don't need to consider their debt. So this is another detriment for FHA financing. And let's see what else. The next one, mortgage insurance. Mortgage insurance lasts for life. Mortgage insurance cannot be taken away on an FHA program. Now, I know in the past, this is prior to, I believe, 1992, If you pass a certain amount of time or a certain amount of equity for FHA, you can remove the mortgage insurance. Is no longer the case. Now your mortgage insurance is for life. In order to get rid of mortgage insurance on FHA, you have to refinance the property out of FHA. So those are some of the detriments for FHA program. But overall, it's a great program. Low FICOs, like I said, more lenient, higher ratios. Everything is good on this program. Let's go to the next one. VA loans. VA loans. VA loans are the best loan available. The best loan available. As a matter of fact, I joke with my clients sometimes because I tell them, why don't you join the Army for a couple of years and then come back to me with a VA loan? Because the VA loans are so super nice loans. Watch this. 100% financing. That means zero down payment. Zero down payment. 100% financing. Number one. Number two, no mortgage insurance. Mortgage insurance on FHA or even conventional loan can run you anywhere between $250 to $450 a month. Imagine that on a VA loan, you can actually purchase a property and save yourselves anywhere between $250 to $500 on mortgage insurance. And I think that is totally fantastic. Another thing is that the funding fee, the cost of funding the loan, can be paid by the seller. So that even the buyer doesn't have to pay for that. So truly, if the seller pays the closing costs and they don't have any down payment, this is a true program where people can come in with basically zero money. And they don't even have to have reserves in the bank. The same as FHA. What is reserves? Reserves is when the bank wants you to have certain amount of money in the bank to be able to make the mortgage payment on the property for at least the next 3 to 6 months, just to make sure you don't default on the loan. On FHA and VA, you don't need to have that money. That means that on these two programs right here, you can have 76 cents in the bank. And as long as all of your cost is paid by somebody, gifted funds from the seller, the family member, the employer, whoever, you don't even have to have any money in the bank. And so that's another advantage, right? Now, it does come with some disadvantages. Number one, it has to be owner-occupied. It can only be owner-occupied by you, or the person qualifying, that is, or your spouse. It used to be in the past that the parents or the kids can live in the property. It's no longer the case. You have to have either your spouse or yourself. Now, so for those people who are going to be deployed, that represents a problem because you cannot buy the property and be deployed because obviously you have to move into the home. So it truly is owner-occupied property. Another detriment, once again, it's both spouses that need to be considered, the same as FHA. I already explained that. Another one is that you need to wait until you're fully eligible for the loan. Fully eligible. Now, full eligibility comes after like 24 months of full-time work with the armed forces. So as long as you've been in the armed forces for about 2 years, you probably should be okay. You need to check with your CO to make sure that you have full eligibility. But for the most part, most people after 2 years, they reach that potential, except those people who are reservists. The reservists, they don't because it takes longer for them because they only go to the armed forces twice a month and I think 1 month a year. So it takes them a little bit longer. But as long as you have your full eligibility, you should be fine. You must have been in active service for at least 12 months before purchasing the home. Now it doesn't say how long. You just have to have been in service for at least 12 months, and that could have been 20 years ago, 50 years ago. It doesn't matter as long as you were in service for at least 12 months. And lastly, the death of both spouses can count against them. So that's some of the things, detriments in regards to the VA loan program. But once again, my feeling, VA is a great program. Another great program is the Sapphire program. This is the Sapphire program. That's another great program. Down payment assistance, FHA guidelines. That means that if you qualify for FHA, chances are you qualify for this program. They do have some overlays. What we call overlays is extra conditions in regards to the loan. So they do have some overlays which you're going to cover right now. But this program here, the Sapphire, will give you the money that you need for down payment up to, I believe, 4.5%, I believe. So you have all the money that you need for down payment and most of the money you need for closing costs. So you only have to bring a very small amount of money. So that's the good part about this program. The detriments of this program. Oh, another thing is as low as 580. So you can go as low as 580 on this program. The detriment to this program is that the interest rate is a little bit higher than your normal traditional FHA. So the interest rate is a little bit higher. But other than that, I give this calculation. Let's say you're buying a $400,000 home. And let's say you need 3.5% down payment. They give you all the money for the down payment, which is around $14,000 approximately. So $14,000, and your payment will increase only about $24 a month. So wait a second, they're giving me $14,000 and my payment is only going to increase $24 a month. That sounds like a good deal to me. All right, so that sounds like a good deal. So check it out. All right. The next one is the Platinum program. Platinum program is the same as the Sapphire, but it only gives you 3.5%. So the amounts of funds is a little bit more limited. Okay, which will give you enough for the down payment. I'm sorry, it gives you 3%, so it gives you enough for the down payment, but you still need to bring 0.5% from your own pocket, which is not a lot, you know, but it's still some. The detriments to the program: 640 FICO score. So it's a little bit higher FICO score than your traditional FHA program, for example, which is 620. Even conventional loans go to 620. This program is 640. So 640 minimum FICO score. And the interest rate, once again, is a little bit higher than normal rate, which is about 0.5% higher than your normal rate on the market. So that's that. Let's go to the next one here. The Cal HFA. Cal HFA is a great program as well. The Cal HFA gives you a first and second and a grant. So they give you a first of 97, they give you a second of 3, that's 100% financing, and then they give you a grant for the closing costs if you qualify. So I think this is a great program also. The only thing is, on the second, this is a repayable second, what we call a silent second. That means that there's no payments on it, but it does accumulate a little bit of interest. I believe it's around 3 or 4% per year, simple interest, which is very, very little, to be honest with you. But once again, it does accumulate that interest, and that second needs to be repaid when you refinance the house or when you sell the house. You need to pay it back. Okay. So other than that, the closing costs can be gifted funds. That means you don't have to repay them back, but you do have a first and second loan. The only thing you have to be concerned about this program is in regards to the income limits and the county limits. They have both income limits and county limits. So the income limit per family, it's around somewhere, don't quote me on this, but somewhere around $82,000. So you have to be, if you make more than that, you may run into a situation in which you don't qualify because your income limit is too high. So you have to check with your lender in regards to that. I don't, from the top of my head, I don't remember the exact numbers, but they do have income limits, and they also have county limits, which are lower than your traditional FHA program. So Cal HFA is a great program for 100% financing, pay closing costs, that means 0% from your pocket, but there is certain requirements that you need to go through in order to qualify, and so you have to check with your lender in regards to that. But it's a great program overall. Let's go to the next one. The 203K program. 203K is a rehabilitation program. They call it the rehabilitation loan. There's two kinds of 203Ks, what we call the streamline and the traditional one, the non-streamline for that matter. The streamline will give you anywhere between $5,000 to $35,000 to fix up the property. Wow, wait a second. You're trying to tell me that FHA streamline, FHA 203K streamline will give me somewhere between $5,000 to $35,000 to fix up my property? Yes, that is correct. They will give you up to $35,000 to fix up your property. And guess what? You can use this money to completely renovate the home. You can do the electrical, you can do the plumbing, you can do new carpet, you can do new kitchen, you can do appliances even. You can do minor roof repair. There's certain things that they do not allow you to do with that money. Some of the things that they don't allow you to do is structural changes to the house. That means you cannot add any rooms. You cannot add a bathroom, you cannot add a bedroom. Another thing is they don't usually allow you to do major roof repair. I mean, they allow you to do roof repair, but if the roof is caving in and you need to change the beams and do structural changes to the house, they're probably not going to allow you to do that. But other than that, you can use that money to pretty much renovate the entire property. Look at this. Swimming pools. If you have a swimming pool in the property and it's in bad shape, you can actually renovate the swimming pool and make it look fantastic. But if you don't have a swimming pool in the house, then you cannot build one. It's just not going to happen. And things like that, right? So this is a great program for renovation. This program is perfect for those properties right now in the market that have been on the market for a long time and they're not selling. And I'll tell you the reason why they're not selling. They're not selling. The market value is okay. So that means the sales price of the property is okay. But they're not selling because buyers think it needs too much repairs and they're not willing to spend money on fixing them. And investors don't want to buy them because there's not enough profit in them to buy the property, right? This is perfect for them. Watch this. If you have a property that is worth $350,000 as an example, and the property needs $30,000 in repair, for example, you can make an offer for $320,000, which is $30,000 less, right? And then you can do the 203K and get $30,000 cash back, so you can make the repairs on the property and bring it up to the value of $350,000. This is a perfect program to do that. Another thing that a lot of people don't know about the 203K is that the 203K can also give you the money to make the mortgage payment on the house while you're not living in the house. Let's say the total renovations is going to take about, let's say 30 days or 60 days, and you're not going to be able to move into the house for 60 days as you're remodeling the property, and you're currently renting right now. The 203K can actually give you the money to pay your mortgage payment for the next 1 or 2 months until you're able to move into the house, and then you can start making your payments. So that's another thing that a lot of people don't know about 203K, which I think is fantastic. So this is a great program to have. The disadvantage of this program is that the repair money needs to be added to the loan amount. That is to say that if you made an offer for $320,000 and you need $30,000 cash back, then the loan amount is going to be $350,000 minus the down payment, obviously. But once again, if the property market value is $350,000 and you need $30,000 in repair, you're not going to make an offer for $350,000. You're going to make an offer for $320,000. That just makes sense. Let's see what else. Seller concession 6%, and then maximum amount of money for repairs is 110%, which is in most cases is okay. And money can be used for repair plus appliances. There's another one which I didn't put in here, but it's the non-streamline, the rehabilitation on the 203K non-streamline. That one can go up to $100,000. So you can get up to $100,000 to fix up the property. That one does allow structural changes and things like that, but it's a little bit more complex. It takes a little bit more time. It can take up to 90 days to close that escrow, okay? And it requires 2 appraisals, it requires 3 bids, and things like that. So it's a little bit more complex. So you really need to talk to your loan officer about this. But the 203K program, rehabilitation loan, is a great program for those properties that are just sitting on the market and nobody's buying them because of the condition they're in. All right, let's go to the last one. The last one is conventional loans, conventional financing. Conventional financing, some of the advantages of conventional financing. Number one of the advantages is that there's a new program out there that allows you to buy a property under conventional financing for only 3%, which is even lower than FHA financing, which is fantastic. So that's great. 3% down payment on a conventional loan. That's fantastic if you ask me. All right, so that's number one. Number two, the FICO score is 600. The minimum FICO score for conventional loans across the board, the same as government insured loans, is 620. So you have a very, very low FICO score. The next thing about conventional loans, here's another advantage. You don't have to run the credit on your spouse. If your spouse is not participating in the loan, you don't have to run the credit. Hence, you don't have to worry about the debt that the spouse has. You don't have to worry about your spouse's debt because that's not going to be considered for financing if that person is not going to come in the loan. This is great for people which spouses have a lot of debt. They may have income, but they have a lot of debt, and that debt is going to disqualify them from buying the loan. The second spouse can buy the property on their own using their own income and expenses, which is fantastic. So that's another good thing about conventional loan. The next thing is mortgage insurance. You can ask the bank to remove mortgage insurance after 5 years or 22% equity, whichever comes first. You call the bank and you say, hey, you know what, I have 22% equity, or 5 years already passed since I got my mortgage. And they will send an appraiser, which you're going to have to pay, but they're going to send an appraiser. They're going to appraise the property, and if that's the case, they can remove mortgage insurance. Remember, on government insured loans, mortgage insurance is for life. You cannot get rid of it. On conventional loans, you can, and that's another advantage of conventional loans. Let's see what else. Gifted funds are allowed. Gifted funds are allowed. So you can have gifted funds if it's your primary home, your owner-occupied primary home. All of the money can be gifted. Even if you're going to bring 10%, 15%, 20%, all of the money can be gifted. The only exclusion to that is on investment properties. Lenders want you to bring at least 5% of down payment on conventional loans for investment properties from your own funds. They want to make sure that you have some skin in the game. So they want to make sure that you have a skin in the game. Let's see, owner-occupied and non-owner-occupied. If the property is going to be non-owner-occupied, aka investment property, All right, you're gonna need 25% down payment. Now, regulation says the guideline says 20%, but most lenders, for the most part, want to see 25%. So that's the only thing. 25% down payment, it can represent a lot of money for somebody. So if you're gonna buy an investment property, 25% is a lot of money. But if you're working with investors, this is a perfect program for them. Some of the detriments of conventional loans, some of the things that are not good regarding conventional loans. Number one, that let's say that they're less lenient than government insured loans. They're less lenient, meaning that interest rate is highly based on your FICO score and your ratios. Think about it in terms of risk. If you have a borrower who has a FICO score of 800 and the ratios are like 2330, right? So very low ratios, right? The interest rate is going to be a lot lower than somebody that has a FICO score of 621 and the ratios are like 43%, like right at the top, right? So interest rate is based largely on a combination of ratios plus FICO score. So the lower the ratio and the higher the FICO score, the less interest rate you get, but the higher the lower the FICO score and the higher the ratio, the higher the interest rate you're gonna get. So that's an important thing to remember in regards to conventional loans. The next thing in regards to conventional loans is that the income, credit, collections, all of those things is less lenient than government financing. In government loans, for example, if you have a collection and the collection is old and the collection is less than $1,000 or represents less than 4% of your income, for example, they may let you go with it. They'll say, you know what, you don't have to pay it off. On conventional loans, collections and things like that, most of the time they ask you to pay them off. They don't want to see any collections on their credit. So that's an important thing to remember. And the next thing is reserves. For conventional loans, you need reserves. You need to have closing cost money. You need to have down payment money. It can come from gifted funds regardless, but you need to have that. But on top of that, you need to have your own money for the mortgage payment. You need to have at least 2, 3, 4, 5, 6 months, depending on what the EU says. You need to have a certain amount of money set aside for the mortgage payment because they want to make sure that you don't default on those loans in the first few months. So that's one of the detriments of conventional loans. Overall, there's a lot of loan programs out there. This is just like the most popular ones. There's a lot of loan programs out there. But most importantly is for you to have an idea what they do, how they work, what are the requirements. Because when people come to the open house, they want to ask you these questions. They want to ask you what down payment assistance program you have. They want to ask you what are the requirements for conventional loans and FHAs and VAs and things like that. You need to be aware of these things. So this presentation is available when you come to the class, so I highly recommend that you do. The other thing, the mortgage calculator, which you can qualify people on the basis of income and on the basis of expenses and ratios. And you can give them information regarding monthly payment, principal, interest, property taxes. You can give them a table of closing costs as well, which is included in the table and all that. All of that information is available, but you really have to come to the class. So I highly recommend that you come to the class. Once again, I'm sorry that I'm going so fast on this, but this is a 3.5-hour class that I had to do in 30 minutes. So I highly recommend that you come to the class. Remember, we here at Berkshire Hathaway Home Services California Properties, we pride ourselves to be one of the only companies that has training every single day of the week except for Sundays. And all of this training is free and available for you when you join our company. So why don't you give us a call, come to the office, give us a call, come to the training. It's absolutely free. I would absolutely love to have you in one of my classes. Until next time, I'll see you then. Bye.